This is our Forex blog for March 7th, 2013. This is showing our currency indexes, which we have for the last 6-7 years pretty much pioneered statistically comparing every currency to every other one and showing you a very easy to read method of knowing exactly statistically how strong or weak each currency is: the dollar, the yen, the euro, and the pound that you see here. And recently we've also come up with indexes for each currency. So in addition to showing you statistically how strong or weak each one is, you can also see it as an actual index of the dollar, of the yen, of the pound. And you can spot all kinds of things, such as here with the euro. When it explodes up like this, draw a trend line on there, and once that trend line gets broken, maybe the uptrend's over. You can see it tried to go higher and it really failed. You can, once you draw a trend line on there, you can duplicate them, and that makes excellent use for knowing when the likely max high is on the next wave up. You can draw fibs on them. You can spot things such as double tops and double bottoms. For instance, here in the dollar, you can see it made a slightly lower high. This is the hourly moving average in gray and the 15-minute moving average in green. And they tend to act as support resistance. As you can see, it went down, came back up to the hourly, just like a regular currency chart. And in fact, just like any stock, future, and any other instrument that you want to trade, the hourly moving average is a very popular support resistance area, and for that reason it works. And so when it comes up and fails here, this is an excellent place to look for sells in the dollar. If you just had the currency meter before this, you would see the daily, weekly, monthly trend is up, and it's going up at that time, and it looks like it's pretty strong. If you didn't have the actual index chart, which we've created these ourselves, it's my belief that some of the biggest hedge funds and trading institutions in the world have probably done something similar, because you will see patterns on this that are just too good to not have other people with lots of money using. So this is a great place to be looking for a sell here in the dollar. You want to sell the dollar versus whatever the strongest one is at 8:30 right here. Let's scroll this one back to 8:30. And you can see that the euro, first of all, is above its hourly all day. So that means it's a sign of strength. It broke out earlier in the day above the previous day euro index high. And then it came down and tested that area for 2-3 hours and wasn't able to go back and stay in under the previous day's range. And of course, when 8:30 comes around and this breaks out, it's already above the previous day's high. The dollar is one of the weakest ones, and so it doesn't take a rocket scientist to know that you want to buy the euro versus the dollar. It's that simple. And by watching an index chart, you know that if one currency is going up and another currency is going down, you stay with the trade. So not only does it help you find the highest probability trades, the one that most likely to give you a profitable trade in, and also the one that's most likely to give you the most pips. In other words, you're not trading for 5 to 15 pips, you're looking for 30 to 50 pip moves. When one currency is screaming up and the other one's screaming down, you're usually going to make 40, 50 pips minimum most of the time. So here's the 5-minute chart. You can use smaller time frame charts like the 2-minute chart. You can do what I prefer, using a range chart, 5 pips per bar. This gets rid of a lot of the noise, and you can also spot pullback opportunities. For instance, when this one first started to go up earlier today, you got this nice little pullback right here. You got an unbelievable pullback right here. And these are places where you can, buy the pullback once the trend line over the highs gets broken. And in fact, if a currency pulls back and then it goes sideways, and sometimes sideways movement will break a trend line, I don't buy until it actually goes above the highest bar here. So it would have been on this bar here at 850.29 with a stop pip or two underneath the low. During low volatility times, just a pip. During higher volatility times, you might want to give it another pip or two just so you don't get. There's nothing worse than having a 6 to 10 pip loss getting out, being on the sidelines and watching it go up 30 pips. That, for me, that's the most infuriating thing in the world. I have no problem with losing money on a trade because, you know, trades are either going to work or they're not. I don't get emotionally invested either way. I prefer them to work. But when you have a profitable system that's based on mathematical and statistical comparison models that we use, you know, you're going to find a lot of 30 to 50 pip wins that'll eat up the tiny 5 to 8 pip losses. And a lot of times when a currency starts up, comes back down, starts up again, it's kind of going sideways right here, I'm going to move my stop up, because at that point it should go up, and if it doesn't, I'd rather lose 4 or 5 pips than 12, and so you can do that. And another tool that you can use is one of our new, and you can see from the 5-minute chart all the activity in here that you really can't see on a 5-minute chart, because these 5-minute bars, the low of this one was around 50, the high of it was around 90, and you can see, you know, you really can't see all the ups and downs it did. Now, during super high volatility times, you can also use tick charts, like maybe a 50 tick chart. And this is also going to let you see, it's downloading the tick data now, this is going to let you see also a lot of those, you know, pullback trades. For instance, you know, pullback right here, this is based on 50 different price changes equals a bar. During slow times, you can see from 6:30 to 7, there's very few bars. There's very little updating of price by all the Forex brokers. And during this active time right here, there are a ton of bars. You know, so during more active times, you have more bars. And tick charts and range charts, you know, one day during an active move, the range bar is going to look better and is more predictive. Other times the tick bar is. You know, that's one of the benefits of having our software is we have 20 different charts or layers that you can put a chart up and hide it, show it, hide it, show it. Right click on this, and you know, you could say tick chart here, and you would therefore not forget what was on layer 11. It's a tick chart, you know. So let's go back to some other examples today. Obviously, the yen is in a downtrend here, which you can see, and in fact, the yen also broke through yesterday's low in the yen around 4:30. The euro was trending up earlier today. The pound was going down. So at that time earlier today, and I'm going to put back a 5-minute chart just so we can see the whole day without having to scroll back. The euro yen at 4:30 was an excellent one to be looking for buys. You can clearly see on this actual chart, it's going up. It's got a nice little flag pattern right here, and it went up about 35 pips here, and then you got a pullback. And look at how, you know, using a trend line to time your entries is so wonderful. And again, the sideways bars cause it to break out, so I'm going to really wait for a breakout over the highest high of that sideways move, which is kind of right around there. So we're going to be long right here at this bar right here at 7 o'clock, and with the stop underneath there, and you can see it kind of gradually went up. But then you got this pullback here. You know, you can either scalp moves like this, where you get in, you make 35 pips, you get in again, you made about 80 there, a little sideways move. I'd be really afraid to buy up here at the high. The higher up it goes, you know, the more likely it is to pull back. But if a currency goes sideways, the farther up it goes, the longer sideways I need it to go. At the beginning of a move, I'm happy with 20-30 minutes sideways, and then if it breaks out, I'll get in. This is the first wave up, second wave up, so it's very likely to have at least another wave up. Count the number of waves, draw your fibs on there, and this is likely somewhere between a 1.382 and 1.612 fib area. You're going to run out of steam typically. So let's take a look at some of the other currencies. You can see here the yen was one of the weakest, and at 4:30 it broke down underneath the previous day's low, and then it went sideways here. So if you are trading the euro yen, you can pretty much see the euro had broken out and was going sideways. The yen had broken out and was going sideways. Really, when it made a new low here at 7 o'clock is when the highest probability time to be in this would be. And here's 7 o'clock. You can see that was really the beginning of this move. So for the previous 2 hours as this thing is kind of going sideways, you're just hanging with it. As long as it stays underneath the previous day's low and doesn't go back above that, it's likely to continue down. There was a new low, and then there was obviously a little bit of buying here. Not enough to push it up, but stop it from falling. And then a new round of selling came in and just kept going down, down, down. You could have, by having these indexes, you can actually see anytime these nice little sideways rectangle patterns. Right here at 10 makes another great place to sell the yen. And at 10 o'clock, the euro was strong. Take a look at this chart here at 10 o'clock. It was going sideways, broke out. You got it quickly made 25 pips, pullback, another 50 pips. So the yen was the weakest of these 4 charts. Let's take a look at some of the other currencies that we don't go over in our blog video too much. Swiss, very strong, especially after 8. It broke out over the highest high of the day, and within a short amount of time was above the previous day's high. So strong Swiss, weak yen means you want to buy the Swiss yen. It's that simple. And you can see, at that 8 o'clock time when it broke out, you had a 100 pip move in a 2-hour time frame. Let's take a look at the CAD. This one, obviously is stuck between the previous day's high and the point of control, which is the price that most traders have positions in all the CAD pairs. Obviously, it's bullish above the point of control. It's weak underneath it. Here's the hourly moving average in the middle. Above the hourly, it's strong. Below it, it's weak. So it's stuck between 2 support resistance areas. Really, only later when it tries to go higher here is it really, a good odds to the move. Same thing here with the Australian, and in New Zealand you can see is weak. So the euro was strong earlier. You can see here when the New Zealand broke down, you could have looked for buys in the euro New Zealand, and you can clearly see very probable moves, and you draw your fibs on the previous swing to get an idea of where your profit target is. And the 1.618 probably 80% of the time is the maximum profit you're going to get. So usually a lot of times it stops at the first one. So if you got into the trade right here, you get out, you buy the pullback, you get out a little bit, half your trade here, trail your stop. When it fails at the 1.618, you get out. And I probably would have avoided buying this next pullback because the risk versus reward is not as high as it was earlier.